Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. In this episode of the Moneymakers podcast, I have the chance to talk to Nick Train, who is the manager, among other things, of the Finsbury Growth and Income Trust. Market capitalization around $1.5 billion. And it sits somewhat curiously, perhaps, in the UK equity income sector. But anyway, it's been a long time since we talked, actually, Nick. It's been 2 or 3 years. And I think I can recall the first time we talked was back in 2001, the very first year that you were in business at Linsell Train. And it's fair to say that it's been a long period of success, but the most recent 3 or 4 years have not been as productive as some of the earlier years.
That is fair.
And it reminded me that I looked up this record that actually the first 2 years of the trust were actually negative years. You outperformed the market, but they were negative years because 2001, 2002 was, as we know, the aftermath of the internet bubble, TMT bubble. So you couldn't really have started at a worse time. But I think you've only had 5 down years out of your total 24-year history. So if we look back over that period, how do you characterize what's happened in the last 3 to 4 years? Why has this underperformance been there?
Well, maybe, as in all of these affairs, there is an element of fortune. The strong periods of performance, you look back at them and you see that luck played a part. And maybe over the last few years, there's been some bad luck. And I think it's important to state that because fundamentally, all of us participating in financial markets, we're essentially dealing with speculative assets. There are more or less speculative assets, but in the end, we're dealing with the limits of knowledge. And really what drives prices is that which is unknown. And that is quite close to betting and speculation. And luck definitely plays a part in betting and speculation. So I table that as a factor for sure. I think, though, maybe more germane, there's no doubt that COVID acted as an accelerant to economic, social, and industrial trends. And those economic and industrial trends, some of them have turned out to be hugely value creating for certain industries and companies, but also some of the ramifications of those COVID accelerated trends have been malign for other industries and companies. And I look back over the last 4 or 5 years and wish that Finsbury had had higher exposure to businesses that appear to be beneficiaries of COVID accelerated themes and less exposure to those that didn't. And we'll see, of course we'll see. When I look back at the structure of Finsbury's portfolio in 2019, so just before COVID hit, and I have to say perhaps not irrelevantly, 2019 was also the relative high for the performance of the strategy. When I look back at the structure of the portfolio in 2019 and compare it to today, actually there have been some really quite marked shifts in theme and company preferences. And I've got to hope that those shifts will lead to improved performance.
So there's a couple of things to unpick there, I think. So on the one hand, the first point you make is that there are good periods and bad periods, essentially. And, your style was particularly in favor, perhaps before 2019, and now has been less out of favor. And that's just part of the game. But you haven't changed your fundamental approach to investing, which is essentially to buy very good companies as you see them with growth potential, and not many of them. And so you're sticking to that. But what I think you're saying is that you've changed the components of that portfolio perhaps more than some of your shareholders might have expected, because you're famous for your low turnover as well.
I agree. Thank you for making it far more succinct than I did. Let me just put some numbers on those structural changes in Finsbury's portfolio just to illustrate what's been going on. In 2019, roughly 40% of the portfolio was invested in data data analytics, software, technology advantaged businesses. Today, the proportion of Finsbury's portfolio is more like 65 or 66%. So there's been a marked increase in the exposure to tech advantaged businesses, let's put it that way. And in hindsight, I wish that in 2019, the exposure had been 65% then, because the portfolio would have done better, because by and large, that allocation to those companies has worked out really quite well. We can talk about some names later, perhaps, but I'm just talking about the broad shape of the portfolio. The other thing that's changed is that in 2019, and this is partly as a result of, as you kindly remark, many years, if not decades, of very strong returns from this type of business. Nearly 50% of the portfolio was invested in consumer branded goods owners. They'd done so well, let's say in parenthesis here, that maybe the most difficult thing for investors to ever do is to recognize when something that's worked for them has worked too much, and that you need to respond to those periods of exceptional return. Anyway, so from nearly half the portfolio in consumer branded companies in 2019, today it's in the mid to high 30%. So not nothing. And I still think that there's a strong case for investing in the best global consumer brands. But within the whole of Finsbury's portfolio, the emphasis on those has declined quite markedly. The other change in Finsbury's portfolio structure, which I think is worth highlighting, is that the exposure to non-UK companies, overseas companies, let's put it that way, has fallen from just under 20% of the portfolio to 0 today. So Finsbury's portfolio is essentially a pure UK equity strategy.
Just to be clear, you mean UK listed companies rather than companies that only operate in the UK. You don't mean that at all.
It's a useful distinction, and you're quite right. The UK stock market, thankfully, one of the merits of the UK stock market is that the history of UK industry has meant that it's an extremely global collection of companies make up the bigger constituents of the market. So yeah, investing in the UK stock market is definitely not the same as investing in the UK economy.
And of course, one thing perhaps you haven't mentioned so far is the fact that the UK equity market is pretty much unloved internationally, maybe changing now, but is unloved internationally, and valuations are very low for comparable companies. Now, that's an advantage in the sense that you would hope to get better returns from them going forward. But there is perhaps some structural issues around the UK market which are also holding you back. So that might hold you back now that you've concentrated more on UK listed companies, or totally on UK listed companies. Would that be fair?
I think it depends on what the major constraints have been on the UK stock market over the last decade or 15 years. And to me, the problem hasn't been so much political or social. It's simply been, for perhaps mysterious reasons, the UK stock market hasn't hosted as many world-class growth businesses as other bourses around the world. Why is it that the UK economy, educational infrastructure hasn't created more world-class, truly substantive growth businesses? I don't know the answer to that rhetorical question, by the way, but I just observe that, to me, that explains much of the underperformance of the UK stock market, simply the lack of exposure to digital technology advantage growth businesses. I think at the heart of what I'm hoping to capture for Finsbury is observing and then wanting to convey to investors that over time, the UK stock market has in fact gradually become more, to use an ugly word, growthy when you look at the constituents of, let's say, the top 10 companies in the UK stock market back in 2001, when you're right, we were appointed to run Finsbury, yes, the market in 2001 was dominated by what have turned out to be 20th century business models without much secular growth opportunity. Oils, banks, and so on. When you fast forward to the top 10 companies in the UK stock market today, although oil is still there and HSBC is still a big index constituent, in fact, there has emerged a number of genuinely substantive world-class growth companies that are London listed, of which we own several. I mean, to me, perhaps the most interesting, because there's a symbolic aspect to this, is RELX, which is a world-class, truly substantive global data business. 2024 was a symbolic year, I think, for RELX and perhaps too for the UK stock market, because in 2024, for the first time in its history, RELX's market capitalisation exceeded that of British Petroleum. Now, BP has been a drag on the UK stock market, sadly, for most of this century. The shares today are still the best part of 30% down in capital terms on their share price in 2001. Meanwhile, RELX, which, just look at the chart, has been a wonderful wealth creator for its owners so far this century, hugely outperformed the NASDAQ so far this century. RELX has moved from, I think in 2001, it was number 67 in the all-share, to being the 5th biggest company in the market today. And as I say, one position ahead of BP. That's just one example of UK-listed growth companies whose success is beginning to become more important for the performance of the market. Does that make sense?
That makes sense to me, yeah, absolutely. So I think there's a question then about the valuations of these companies. One question I could have put to you, say, well, if the UK market is not as appreciated as some of its component companies should be, why don't you just go along to them and suggest they go and list in New York? But in some of these cases, the valuations of your companies are already quite high on conventional terms, are they not? So what I'm trying to strip out is whether there is a UK market sentiment factor involved in there or not, in your opinion.
There are a number of things to analyse here. Listen, I want to be absolutely clear that I do not believe that the UK stock market as an entity is cheap because the dividend yield is so high and the price earnings ratio is so low in comparison to other markets. Those ostensibly low valuations are simply confirming the lack of secular growth opportunities in many historic UK businesses. When you look at the valuations of the companies that make up the heart of Finsbury's portfolio, which are, we sincerely hope, world-class 21st century relevant growth businesses, we can access them, including RELX, at a moderate discount to comparable companies listed elsewhere, most obviously on NASDAQ. But again, that's not really the basis for the investment. I mean, it would be nice if there was a 10% pop across the portfolio because that valuation gap just narrowed to nothing. I don't know if that's going to happen. It doesn't need to happen. What does need to happen, though, for us to make money for investors is for the companies that we're invested in, and let me just throw off some other names here in addition to RELX. London Stock Exchange Group, the world's #1 provider of real-time data to global financial institutions. Experian, the world's biggest credit rating agency with more data on more individuals and more corporations than virtually any other entity in the world. To talk about a domestic business, Rightmove, with this extraordinary position that it has digitizing the UK's real estate property market. What really matters is that these companies demonstrate the sorts of growth rates and returns on capital that the best US data and technology companies already exhibit. Because if those UK listed companies are as profitable and do have as big growth opportunities as those US peers, then there's a lot of money to be made by being invested in them. That's what I'd say. It's not so much the valuation, it's the scale of the growth opportunity.
And you make the point, I think, in one of your recent reports that the return on equity across the portfolio is about as high as it's ever been. I think you said that last year, 30% or something like that, which is very handsome. So that would appear to validate your approach, provided, of course, that those return on equity can be sustained. And of course, that brings in the question of, in a digital age, whether the competition is increasing or decreasing. I don't know what your thoughts are on that, because that would be fundamental to whether or not these high growth companies, which you are paying quite a significant price for in valuation terms, are capable of delivering the kind of returns you want.
I agree. You remarked earlier that the underlying investment approach hasn't changed. Perhaps some of the industries or individual companies that we've chosen to participate in that investment approach have changed, or we've changed weightings. But the fundamental proposition that a way to create value for investors is to own a small number of very, very high quality, high return businesses, that remains probably even more relevant for Finsbury today than at any point in its history. And by that, I mean that the portfolio concentration of Finsbury, I think, is at an all-time high level of being concentrated. And perhaps it's right, what I was saying earlier about COVID acting as an accelerant to beneficial, but also to some malign trends in industries. I think you could sustain the case that the mass adoption of digital devices and tools has enhanced the value of data, proprietary data. And I think the common denominator for almost all of the major holdings in Finsbury is that they are companies that own, curate, and accumulate large amounts of data that's unique to those businesses. I think that's the moat for those companies, and that's what's going to sustain the returns on equity that you rightly say are necessary for the valuations to be merited. I think, on the other hand, we can see increased pressures on mass market consumer brands. Price finding, own label, the emergence of the discount retailers is definitely leaching away brand equity from the owners of undifferentiated consumer brands. And I feel it's even more incumbent on us than ever to be sure that those consumer companies that we're still invested in do have products that are at least sustaining, if not improving, their brand equity. We mentioned going to the pub just before this conversation started, and I rather flippantly pointed out that we're happy that people are willing to pay £7 a pint, if it is £7 a pint, for a pint of Guinness. And I think Guinness is an example of a storied brand, whatever it is, 260, 270 years old, that is arguably still just coming into its own as a global brand. It has a unique taste and a unique proposition to consumers. And as a result, Diageo have been successful in growing Guinness's revenues at double-digit rates per annum since COVID. So I table Guinness as an example of a consumer brand that's becoming more valuable currently. And it'd be nice to own more such brands.
Even if the share price of the parent company has been disappointed recently.
Well,
if it's becoming more valuable, the market doesn't seem to recognize that at the moment. I mean, Guinness is only one part of it, of course.
That's right. I mean, it's a non-trivial part of Diageo. It's probably 16 or 17% of the business, but you're right. And Diageo does have other more troublesome parts of its business currently.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. How do you react when you have disappointments? Obviously, you say you've got a very concentrated portfolio, probably more concentrated than any other fund in the UK. I can't think of any others off the top of my head. You're 90% or so in the top 10 holdings, and you're obviously watching that basket very carefully, to use a phrase. But how do you react when you get a disappointment, like a recent disappointment, like Diageo or Burberry? Is your first instinct always to say, I'm thinking about doubling down on this one? Because if my analysis is right, I should be doubling down. If my analysis is wrong, I should be getting out of there. How has that played out with those two names?
Well, you're right. The first instinct is always to buy more, which I just think is a constructive. It's said that there are two types of investors. There are investors who cut losses quickly, or there are investors who are willing to average down. And I've always had respect for Bill Miller's proposition. Do you remember Bill Miller, the Legg Mason US growth manager, who had a tremendous period of success and then a period of less success, but nonetheless is someone worth looking back on. Bill Miller said somewhere that he who has the lowest book cost wins. So looking for ways to reduce your average in price, if you're accessing a business with enduring qualities, that's a sensible way to approach the investment challenge. And I've looked to discipline myself and my colleagues to do so.
So how are you treating those two stocks we mentioned, Diageo and Burberry? What's your thinking on them now, today?
We are adding to Diageo when we can, and we are maintaining the weighting in Burberry, attendant on further evidence of success by the new chief executive and relatively new finance director in demonstrating the claim made by the new chief executive that Burberry could and should be one of the 5 or 6 most valuable luxury brands in the world. That's a very reassuring proposition from the chief executive, and it's one that I agree there is that potential for this brand. With the size of our holding currently, though, I think that I'm happy to see whether they can demonstrate more progress to achieve that.
So that's been a management failure, essentially, rather than a strategy failure on their part, or both.
I'll tell you the common denominator to both Burberry and Diageo is that both companies executed quite substantial share buybacks at, in hindsight, inopportune prices and junctures in the performance of their industries. And it's a difficult lesson to learn from, but nonetheless, it is a lesson to observe that boards can make the same sort of mistake that we as investors can make as well, of placing too high a value on their equity and buying it back at the wrong price.
There's a point that Warren Buffett's made many times, of course, and others, that a lot depends on the price at which you buy back your shares and whether they are good value or bad value, right?
Absolutely. If you can buy back your shares at a price that's below the intrinsic worth of the shares, then that is hugely accretive to those investors who don't sell. Unfortunately, that intrinsic value is an unknowable, but you hope that the combination of the executives and the non-executives in a business with more insight into the company's operations and maybe more understanding of the industry in which they operate than the average investor are better positioned to make that judgment. But sometimes they can get it wrong. And that's, I think, to some extent, the magnitude of the share price drawdowns for both of them is in part explained by those share buybacks at the wrong price.
And would it be presumptuous to say that an element about executive remuneration might play a part in these decisions? Which is something I guess you have to keep an eye out for, if you like, management's gaming the system a little.
I don't know. I think that if we want world-class, substantial, globally significant companies to be listed on the London stock market, and I think we do for all sorts of reasons, then I think we have to accept that successful executives ought to be highly remunerated.
But for their success, not for necessarily their failure.
Obviously, but that's hard to demonstrate except with hindsight. Listen, I agree with you about gaming remuneration, but I'm cautious about being overly censorious and being puritanical about it in a way that disincentivizes people to take smart decisions.
Okay, so we'll come back just in a moment to the outlook for Finsbury Growth Trust. But can I just ask you, because you mentioned buybacks and so on, about the impact on a fund manager, in a period when we have seen the investment trust sector experience significantly wider and persistent discounts and the arrival of activist investors on the scene, obviously culminating in the Saba campaign. Your board has consulted widely with shareholders, I know, about the performance, reported that last year. You put in place a continuation vote in a year's time in 2026 and bought back an awful lot of shares. Now, I'm interested in how that impacts on what you do, because obviously one of the attractions of the investment trust structure is meant to be you have patient capital and you don't have to deal with flows in and out and so on. But this kind of environment, how do you see that? Is it making life harder for you or easier for you?
It focuses the mind. And I've got to believe that that's beneficial for shareholders. When there is a buyback, you've got some options about how you respond to that. You can choose to allow the levels of gearing or debt to increase, or you can choose to sterilize the cost of buying back the shares by selling something. For a variety of reasons, I've chosen to raise cash to meet the cost of the buybacks. And that has really focused my thinking about where the greatest value is in the portfolio, because of course I want to retain the highest exposure I can to where one sees the greatest investment value. So to that extent, maybe that sharpening of thinking is valuable. Listen, I'm a significant shareholder in the company myself and continue to add to my holding. As a professional, of course, I'm disappointed when the size of the company shrinks. But for me, there's a huge offset that when the company shrinks, the net asset value for those shareholders who don't sell goes up. However, marginally, it does go up. And when you look back over the sweep of it, Finsbury's share buyback program has now markedly, not enormously, but has markedly enhanced the net asset value for non-selling shareholders, as well as, of course, providing liquidity for those investors who have wanted to sell. And I think that's a good thing. We were talking earlier about share buybacks, and they create value if the buybacks are done below intrinsic value. Finsbury's net asset value, and indeed its share price, is pretty close today, after a better period of performance over the last 6 months, pretty close to its all-time high. That means when you look back, all of those shares that were bought back have been bought back in a way that's been very, very accretive for ongoing shareholders. So I think that's okay.
I was looking at the figures again this morning, and basically the trust shares traded either at par or at a premium for about 11 years, between 2010 and 2021. And since then, they'd moved to a discount and remained at a discount. The discount reflects the fact that there's more sellers than buyers. What's the message you're getting back from your shareholder base? Perhaps I should ask what the board's message back from the shareholder base was as well. They want you to continue, right? The ones who remain want you to continue doing what you're doing. I hope that's right. I assume that's right.
Listen, I think it's been, to me, the great achievement of my career, my history and association with Finsbury Growth and Income Trust. And it's been one of the most flattering things that I can conceive of, that for a long period of time, as you remarked, the shares traded at a premium to net asset value, because that's indicating that shareholders believe that what you're doing is likely to create substantive value over time. And I think it's perfectly explicable that the shares should be trading at a discount after 3 or 4 years when I failed to deliver those returns or to match the historic track record. Yes, the remaining shareholders, still £1.5 billion worth of them, have by and large been supportive and encouraging of me and colleagues to stick to the disciplines and approach that at least have worked historically and hope for better times. And I don't see really that there's any alternative to that for Lintel Train Limited and for me personally. There isn't an alternative investment approach that we have within this business that we could apply to FGT, so we won't.
So you put in place this continuation vote, or the board has, but that's not going to change what you do. But I wonder how far these changes we've talked about, the share buybacks and the focuses in the mind, is that been a factor behind the greater concentration of the portfolio, that you've really put your money on your 10 best ideas effectively? Has that been a conscious process, or has it just been something that's fallen out of what's happened?
I do think that there is an element of responding to a period of disappointing performance by focusing on your best ideas. Yeah, I do. But I also think that it's a result of the opportunity set within the UK stock market, that there are not so many globally significant growth businesses listed on the London stock market. I think that we've identified 15 of them, say, and we've wanted to ensure that within the portfolio construction rules and maybe the rules of prudence, that we own as much of them as we possibly can. So that's a factor as well.
So let me then finish by asking you this question. Suppose I was, and indeed I am, I guess, someone who's looking at the trust and saying, I'm interested in investing in Finsbury Growth and Trust at this moment. It's trading today on a 6% discount or something like that, I think. And the board has talked about being committed to within around a 5% discount as the kind of target. Against that, I can get for something percent on a gilt. Inflation is at 3% or something like that, maybe. So that gives me a 1% real return if you actually achieve any of that. What's the argument for investing in your trust at this point in time, when obviously there's a lot going on around the world? There's talked about tariffs or anything that average may impact on businesses and so on. What is the actual case for buying your specific trust at this specific point in time?
Well, I'm cautious about these portfolio-wide statistics, but you noted earlier that the average return on equity across Finsbury's portfolio is at an all-time high of roughly 30%, and that is right. And that is one of the things that has gone up since that previous peak in the share price for Finsbury and relative performance back in 2019. The average return being generated by the companies that we're invested in has gone up, and that's gone up as we've increased exposure to these London-listed world-class data and software companies. And that 30% return on equity that they offer as businesses, as you remarked earlier, if they can sustain those rates of return, sooner or later, their share price total returns will begin to converge on that high rate of internally generated return. I think that we are at a fascinating juncture for the earnings progression of the major holdings in the portfolio. I think that there are good reasons to think that the rate of earnings per share growth for a RELX, for an Experian, for a Sage, there's a case to argue that their earnings growth is going to accelerate from here. If that's right, that combination of accelerating growth and the still persistent discount applied to their shares because of their London listing could result in a marked and meaningful uplift in their share prices and hence Finsbury's net asset value. I think that's probably the central reason. Via this portfolio, you can get access to most of the major money-making industrial themes evident in world markets, and you can do so at a discount. That ought to be a significant opportunity.
So that was Nick Train, the manager of Finsbury Growth and Income Trust, talking to me this week.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.